And joining us right now to talk more about the markets on this first trading day of December is Joe Zidle. He's the chief investment strategist at Blackstone. And Joe, it's great to see you.
Thanks, Becky. Thanks for having me.
All right, markets have been off to the races, running up, up, up. You are a little concerned that things could be overbought here. You're still overweight in cash. What worries you?
Yeah, so we are sitting out. We took our cash allocation up last quarter to 10%. And, really what we're recognizing here is this tension between, liquidity on one side and fundamentals on the other. On the liquidity side, we had a 10-year Treasury yield that started off the year at 2.4%. It's now down to 1.83 or so. The Fed cut 3 times, these preemptive cuts, and they've, restarted some form of quantitative easing. So that's all on the liquidity side. That's really, really good for valuation. But the fundamentals haven't kept up, right? We're looking at an environment where we've got slowing global growth, a manufacturing recession, and
we're not looking at recession as clearly as it looked like we were a while ago. Are you getting a little frustrated as you watch the market continue to run with this?
Well, we know
you
that.
Took off your glasses for this.
I'm getting serious. I forgot to take these off. My wife and kids tell me to take them off before I go on air, so little slip up, guys.
So where were you? I've been giving you grief for the entire way up, but when did you? Because you were bullish.
Yeah.
Until what? Do you remember the date?
Really, it was late August, early September. It was as soon as we got those 8 to 10 yield curves.
We were at like 2,800.
Yeah. Yep.
That hurts.
No, it's a wall of worry.
So when would you say, all right, I miss 15%. I'm not going to miss any more. You just go somewhere else and start over, or how do you get rid of that? Do you ever capitulate and say I was wrong?
Well, there's two dynamics, right? There's the interest rates and the fundamentals. I think the challenge for me when I look at the valuation of the market is we have fundamentals that really haven't kept pace.
No, I know, but I'm saying right? if you continue to be wrong, that's what you've been saying. Mm-hmm. If that continues to be wrong, when do you say, okay, I'm buying at 31.50?
I think the key for the next 6 months is going to be whether or not we can get some sort of resolution to trade, because that would help restore confidence.
And then you'll buy at 3,200 after being at 2,800, or?
Well, think about the role of CEO confidence here. Think about how that impacts everything from CapEx to hiring decisions, how it's going to impact sales, profitability.
I was just wondering what you're going to do, not CEO.
Positive driver.
I just want to ask about, you mentioned global growth, but when I look around the world, global valuations aren't particularly high. So in Europe, PEs, I think forward PEs like 13 or 12.5, 13. So it feels like that's already priced in, and there may even be further upside in stock prices all around the world.
Yeah, I think there could be, and it's because, you've got like elections in Germany that now are ushering in the prospects of some sort of, fiscal policy, some sort of fiscal stimulus. And so there's a lot of liquidity, right? Global debt has surpassed $250 trillion, right? It's about $86,000 per capita. So you have a lot of liquidity out there with very few real opportunities. I'll give you an example. You mentioned Germany, right? Germany, France, and Italy, the 3 big in Europe. The 3 of them combined have added about 5 billion euros to GDP growth in 2019, but over 500 billion euros to the market cap of their respective indices. So in other words, you have all this liquidity going to financial assets. It can probably push them up higher. Does that mean that we're in a good spot fundamentally? The U.S. is trading about 20 times trailing 12 earnings. Historically, if you're deploying cash at 20 times earnings, your 10-year forward returns are actually below average.
Yeah, but,
so
the 10-year rate wasn't at 1.83 in those environments.
Yeah, how much lower is the 10-year going to go? I think it's an open question. We've gotten 3 cuts from the Fed, and the Fed said that they're on hold, right, unless we get some sort of material, reassessment of the economy. And, you also have them expanding their balance sheet again. So how many more tools do they have left to push down, the 10-year or to push down rates in general? I think we've hit a secular low in the 10-year. My guess is that the next move is actually going to be a little bit higher.